In today's video, I am going to be breaking down how you can really research different ETFs so that you know what you are investing in, and basically some tips that I can help you with to pick the right ETF for you. Let's get down and let's check these out. So we're going to be looking at American and Canadian ETFs. So if you're Canadian, don't worry, we will be looking at Canadian ETFs. But first, we're going to be looking at VOO, the Vanguard Sp ETF. This is an ETF that will mirror the stock market in the United States, the S&P 500. Anytime that you get an index ETF, especially one that is a very broad one, you really want to look at the expense ratio. You want that to be as low as possible because that is technically going to make you even more money. See, what a management expense ratio is, MER, is basically how much it's going to cost you to invest your money with that ETF. Because we have to remember that there is a lot of infrastructure behind an ETF where they are investing your money for you. For example, in something like an index fund, it's usually calculated and rebalanced every week or every day or even every month, and it's usually done by computers. Obviously, computers cost money, servers cost money, and just the infrastructure and just holding your money in general costs money. And with a 0.03 MER, that's extremely cheap for VOO. That's why I like that one over the other S&P ETFs that are out there, for example, SPY, because it's a bit more expensive. While if you're looking at an ETF that has a lot of trades that are happening that are not broad index market funds, it's sometimes a real person or real people who are doing those trades, and that's why those specific ETFs may cost even more, upwards of 0.5% to even 1 or even 2%. That's why mutual funds are usually like 3% because it's a real person doing the trades. Next you want to look at is the average volume. Average volume is ridiculously important, especially when you're talking about ETFs. ETFs are huge when it comes to volume. When you are trading an ETF, you want to know and you want to make sure that there is enough volume if you want to get out of that ETF that you don't have to wait and see if you can actually get it sold. The ETFs that have maybe 500 volume or 1,000 share volume and you're looking to buy 10,000 shares, well, that's going to take a very long time to go through and a very long time to sell. And if you're looking to have basically liquidity to be able to get in and out of the stock market quickly, you want something that has high volume. And depending on if you are a dividend investor like myself, yield is extremely important. And when you're talking about broad market index ETFs, the yield is not usually going to be very massive. As we can see here, it's 1.34% for VOO. And because it's holding stocks that may pay 4 or even 5% dividends, it's also holding stocks that don't pay any dividends at all. And because of that, that draws down that average yield across all the stocks down to that 1.34%. Now, if you are reinvesting those dividends into the ETF over a 20 or 30 year period, then you don't really necessarily have to worry about that yield. It's kind of a nice bonus, especially if you're reinvesting it, because then it's just going to grow even more. It's called compounding. The other thing you want to look at is the chart, and something I really personally like to look at myself is the 3-month chart. And then that reasoning is when you go down into what's called the MACD, when you start seeing the stock market go down, that is usually that green line going over top of the blue line in general. Now, if you're seeing that there is an uptick or an increase in stock price and that green line is still above the blue and the blue is starting to get closer, what will normally happen is once this gets to a point where it's going up and that blue line crosses above that green line, then what will happen usually in 99.9% of cases, this will skyrocket up even higher. And when you're looking at something like VOO or SPY and you see this happening, that usually means that the broad market including pretty much most stocks that you may even invest in, will continue to go higher. This is actually a very good sign as to what's happening right now. And then if you look at the 5-year chart, you can see again that this is a pretty solid ETF to invest in, because there's a couple of times where you would want to invest. Anytime there's a downturn or bad news coming out of the economy, the stock will go down on this ETF. And then, of course, when there's good news, it will go up. Well, guess what? By investing in something like VOO, you're betting on the basically total market itself, which will always go up, usually on average of about 8% a year. You also want to look at the stocks that are in the ETF itself, because the stocks that the individual ETF holds is extremely important. The reason because of that is if you are investing in an ETF and you disagree with one or multiple of the companies, then you may not want to invest in that ETF. And your reasonings may be something as simple as you just don't like that company, to something more advanced like you just believe that company is going to zero, so why would I invest in an ETF that holds that company? That would really hinder that ETF's ability to make you money. So depending on what your thoughts are, some of these ETFs that are made might not be for you. If you disagree with Facebook, then you may not want to invest in an ETF that holds Facebook stock. I personally disagree with Facebook, but I still believe that they can make a ton of money. So then you just kind of look at it and say, well, what's the worst of two evils? And then there are BMO covered call ETFs. It's not just BMO, this is a Canadian ETF, but covered call ETFs. What are these? What are they about? Why are they so expensive? Well, covered call ETFs are usually pretty expensive, 0.7%, usually on average, depending on which one. And that is because, for example, if they hold TD stock as an example, and let's say they got 100 shares of it, instead of just holding on to those 100 shares and having the stock price go up, well, they can make a little bit of a bet, and they can sell an option for those 100 shares to somebody over here, and we'll give this person a smiley face, and from there, they'll give the option to buy those 100 shares at, let's say, $91, and they are currently worth, let's say, $80. And that option is to buy those shares at $80 6 months from now. Just as an example, if they don't hit that $91, then this person doesn't get his shares. And he paid a premium to us of, let's say, as an example, $150. Then at that point, we keep that $150, we keep our shares. He's out $150, but we just made it and it's paid to us in a dividend. And now this specific dividend or ETF currently pays in that 6% range. This one will only hold American banks. So by running with covered call ETFs, it's actually a very good option when the stock market tends to do nothing for a while, because what you're making at that point is massive yield or massive income from those shares, because you're still getting paid the dividends from the shares that you're already holding, plus you're getting that income from those covered calls, because now you are essentially playing the casino and that person is essentially playing the gambler. In layman's terms, that's essentially what you're doing. Now, the nice thing with this ETF is it hasn't been around for a very long time, but we can see that before the COVID pandemic, it had a nice small uptick. It's recovered since the pandemic, and if the banks continue to do what they're doing, this will have probably a slow uptick with a 6% dividend, which is just absolutely amazing. And if you were lucky like I was, you could get that when the market went down right here at well over 10%. At one point, I was getting it at close to 11%. And we can see from the actual website itself, it's 0.71% management fee with a 6.08% dividend, or yield, I should say. Its biggest holdings are these banks. Again, American banks. Citizens is a pretty popular bank, and same as Ameriprise. These are all big banks. And then there's also ETFs that will hold things, not necessarily investment, but things in general. And what I mean by that is there's ETFs that will hold singular gold. For example, GLD is an ETF that will hold that, while something like BTCX.U will hold Bitcoin in US dollar amounts. And when that is the case, you can actually invest in things that you may not have access to readily in smaller portions. So for example, if you don't want to go out and pay whatever it is for gold, $2,000 an ounce for gold, you can put $500 into an ETF that holds that, and then you can play the gold system. Or the same thing with Bitcoin. If you don't want to go out and spend 60 something thousand dollars Canadian for one singular Bitcoin, you can go out and spend $2,000 or $4,000 or even $500 on an ETF that holds Bitcoin as well. And you can kind of still play that same market. Now, the difference with these is on average across gold or even a silver ETFs, Bitcoin ETFs, usually what you're looking at is a management fee of around 0.4%. That is kind of the average across all of them. I've also read stories that there's a few people or companies or banks that are starting to create ETFs that will hold baseball cards, basketball cards, and things along those lines, where you can invest in basically different things like cards, as an example, to be able to not have to go out and spend $5,000 or $10,000 on a Michael Jordan rookie card, or even a $4.6 million Luka Doncic rookie card. Then you can just go out and spend a couple of $100 on an ETF that holds those assets. I'm not too sure how they're going to be able to really organize that, but it's actually a very interesting proposal to really consider. And this is that Spider Gold ETF, that GLD I was mentioning. It's 0.4% for the MER as well. And the average share volume of that is around 7 million shares traded per day. So it's a very interesting option to invest in, considering that an ounce of gold is close to $2,000. And one single share of this is $166. Sometimes it's a bit easier to get into this than it is an ounce of gold. So there is the breakdown on ETFs, things that you can really look at yourself, and if it's a good investment in your mind, that you could invest in it. Remember, make decisions on your own. Don't trust a random person on the internet. I hope that you've enjoyed today's video. I'll see you guys again next time.